Good morning, traders. It's Tuesday, January the 7th, taking a look at the charts. We've got the SP 500 daily chart here. And last week, obviously, we had news with the missile and that stuff going on. And if you look at the market, you can see here in the grand scheme of things, I know there's a lot of emotions flying around, a lot of stress in the market. But if you look at the overall price action of the SP 500, in the grand scheme of things, it's nothing too significant. All it really is the market's rallied up, it's consolidating, and this could still be a point where it could continue to extend and more or less take this move here. That same measured move would be measured to the upside. So in the grand scheme of things, we're still holding up. The market is still in an uptrend, but there are some early warning signs that there's potentially going to be a rollover. We are along the SP 500. Each day that the market consolidates and has this kind of churning here where we're seeing some distribution selling followed by some big buying in the market, it does kill to some extent the momentum, and we could start to see a rollover. And there's a few things starting to show signs that that is potentially happening. If we take a look at the chart of bonds, if you look at the daily chart of bonds here, you can see we've been in this big consolidation, and really this is a massive bull flag. Market has rallied up. It's been consolidating. We're at this 200-day moving average, which is a really significant level. We've got this falling trend line here that price is still struggling, trying to break through, and we'll see if it can get some traction and hold this level and start to go to the upside. And bonds tend to move first. If we go way back in time here and look at some previous price action in the market, the last time we saw a market where it pulled back, consolidated, came back up, and then formed a big bull flag was over here. And you can see how it resolved to the upside, more or less. The rally to the upside, well, you get the consolidation, you get that same measured move to the upside, give or take. But usually you see the move, and then you see the second half of the move. And that's where we are here. We've got this big correction in the market. It's come back. We got this big bull flag forming. If this starts to break to the upside, it could mean the stock market is going to or is falling, and we could see a very strong move here for a major double top in bonds. So there is some potential. Now, if we take a look at the shorter term chart, let's just jump over to our short term trend analysis. This is the chart of bonds here, TLT. You can see here, this is the 20-day moving average. This is the SP 500 in the 20-day and the GDXJ. Now you'll notice the GDXJ and stocks are above the 200-day moving average. They're sloping up, and the bonds here are trading. They've broken through. They're above the 20-day. The 20-day is starting to flatline here and on the verge of rolling over. And our short-term momentum saying, hey, short term, the market is showing signs that it's starting to roll over. We got orange bars here. Our cycle is down near the lower reversal zone. We could start to see there is a sell-off yesterday, a rebound. The second half of this move could bring us back down to the 20-day, but overall the momentum is shifting, and bonds tend to move first, and this could be the very beginning of a rally in bonds and near the end of this rally in the equities market. Now, if we look at the SP 500, the middle chart here, we talked about how yesterday this is our oversold indicator, this is our overbought indicator. It's on each chart here. Same with bonds. These are the levels here. And more or less, yesterday we saw the gold miners gap up into resistance, and more or less they sold off through the session. Of course, they've had a huge rally, and this is why they're overbought. They've had so much, a large enough move in a short enough time that it just needs to continue to pull back. And these rallies into this oversold zone just get sold off, and the market pulls back. It's happened 4 times now, and we'll see if it can get some traction over the next little bit. But again, the 20-day is a really critical support zone. This could continue to consolidate, maybe pull back further as the 20-day kind of moves up. But we'll see how things unfold. But overall, there's still very bullish sign in the market. In terms of the momentum is still up. We do need to find some traction here soon and start to go to the upside as long as it can hold the 20-day. But let's take a look over at the SP 500. SP 500, same type of thing. This overbought territory, you can see it sells off each time it gets into these levels. We saw a year-end rally just buy programs stepped in, bought the market up. I heard there was a surge of about $6.5 billion right at the close that created this big squeeze up. Huge programs came in the last day of the year, bought up the market, probably window dressing, make them look like they're all owning the top performing stocks for their clients. But overall, then we got the oversold condition in the market. When it gets down to these levels, naturally wants to recoil and move back up. And that's what we saw yesterday. Big gap down, big gaps. Gaps in general tend to get filled, so natural bias is to the upside, but it was oversold. The VIX was spiking as well. There was fear in the market, and when things are oversold and everyone's fearful, that's usually when the market rallies and catches them off guard. And of course, the opposite for bonds. They went from an overbought territory, they gapped higher yesterday and sold down, more or less doing the opposite of what the equities market is doing. So overall, we are still long miners and the indexes. They are still holding their ground. They're consolidating and churning here, waiting for a breakout in either direction. Trends are more likely to continue than they are to reverse, so we are continuing to hold, but we do have some early signs here of money moving into the risk-off assets, like utilities and gold and bonds, and that's a sign that we may start to trim or tighten our stop, or we might end up reversing out of these positions depending on how the other markets react over the next couple of sessions here. Now let's go back to, let's pull up the chart of gold. Gold really extending and moving higher. Obviously, it is seen as more of a safe haven than gold miners. Gold is the global safe haven. So if obviously there's issues overseas, which is what we've got right now. Overseas traders don't go and buy American stocks, not as much as they're going to go in and buy physical gold bullion as a safe haven play. So physical gold is definitely leading the way. And it is trading up near this previous high, which is where gold miners are more or less trading to some extent. If we get extension or any more of this news, we could really see a huge blow off top. But overall, the move here for gold is more or less done to some extent that it needs a breather. When we have a huge surge, we usually see a pullback, huge surge, pullback, huge surge. The bigger the pullback, the bigger the rally, the bigger the pullback. And of course, we've had a pretty decent rally here. I wouldn't be surprised if it consolidates and pulls back for a few weeks, potentially before going higher. But if there's obviously news or events happening, this could go parabolic and we could see it rocket higher. But don't be alarmed if this consolidates and builds some type of launch pad here, a bull flag for it to rally down the road. Looking over at gold miners, here's GDXJ. You can see it's flirting up with these recent highs in the market. It's not the sexiest looking chart in terms of it keeps gapping higher and selling down. I hate to see the market gap higher because usually the market makers walk prices up when there's no volume. Then they can sell at a premium and short it and try and drive the price back down. And that's what seems to be happening. We got a lot of overhead supply here. There's a big net short position for commercial positions, meaning they want the price to go down because they're short. So they're playing these games and holding the price down. But if this starts to break out and starts to run, all those shorts are going to want to cover, and we could see a very strong move to the upside. If we were to just squish this chart down, you can get an idea of the overall upside target of this whole move with a Fibonacci extension. We go from this previous low to this rally high and down to this low and carry it forward. To squish the chart down, you can see the upside potential here where miners rallied up, they consolidated. This would be the first key level where it's going to find a first pause or pullback, and then the upside target is 50.60, which is just this completed momentum move. So we'll see how things flag out here, if they continue to flag and build a launch pad to go higher, or if we're going to just see an explosion and a huge short covering squeeze. If this pops and goes straight up, that is, to me, is a little bit more bearish of a sign, because what goes straight up from this point, I think, could very easily fizzle right back out once the shorts have all covered. And then I think it would consolidate again before going to even new highs. So we're just going to let the market keep doing its thing. We're going to follow the trends and go from there. Looking over at natural gas, down 0.6%. it is starting to get pretty oversold. I'm really liking this pattern. It has been dragging out forever. We were looking for a bottom to start forming more or less over here in the beginning of December. It continues to go down. We now have this three surges to a low, one, two, three. This kind of drawn out sell-off is a sign that people are starting to give up on it. There's not panic selling anymore in natural gas. That is over. These waves of panic selling are done. Now it's just people slowly rolling over on the position saying, I give up, and they just continue to trickle out and sell their positions, and it just keeps a steady negative drag on price. We saw this happen in 2008, 2009 during the last little bit of the market. This happens all the time in stocks and asset classes. So we're just going to let this continue to work itself out. Ideally, I'd love to see it come down, tag this low that we saw over here. And that's also a Fibonacci measured move. If it gets down to this area, I think we could see a knee-jerk reaction bounce. If it can start to break this 20-day moving average, we could be off to the races for a very significant rally to the upside. But again, we're not getting involved yet until we hit a very significant support zone or we start to see bullish price action form, and we want to get in before it takes off for the real takeoff in the rally there. Looking over at crude, down 0.6% as well. We talked about this yesterday in pre-market, that oil trading up into this resistance area through these highs over here. Obviously, major resistance. You can see the selling that took place both times that this level was hit. This was the last missile strike, or sorry, the previous missile strike. This here is the current missile strike. We're back up at this level, and we'll see what kind of pattern starts to unfold here. But obviously, we got to be aware that this could have a pretty significant sell-off. Right now, the trend is up. Trends are more likely to continue, but this is a very significant resistance zone. I would not be looking to get long here. I'd be looking for a bearish pattern, reversal signs for a potential pullback and correction in crude. Anyways, let's pull up the US dollar real quick. US dollar, obviously big sell-off in the dollar. It's had more than its fair share of a measured move. If we take this high down to this low with a Fibonacci extension, this here was the measured move where the downside target was expected. It has broken through this red line, this 200-day moving average, Fibonacci move, and now it's starting to show signs that it's trying to put in a bottom here. We're starting to get a little consolidation and gaps in the price. Obviously, falling dollar helps boost gold. We've seen gold do the exact opposite of what the dollar has done. But overall, this is a three-wave correction. This is a 1, 2, 3. I wouldn't be surprised if we start to see this come back up and fill this potential big gap in price over here. This is going to act as a pretty significant resistance area, and this could put some downward pressure on metals and hold them muted for a little bit while the dollar maybe rebounds. But overall, we're going to just continue to let the market do its thing. Anyways, that's it for now. Talk to you in a bit. Bye-bye.